You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hey guys, Coach Kelvin here. Today I wanted to talk to you about the age-old question or the argument that you need to have a house that is paid off in order to reach early retirement. Now there's a big population or a lot of people within the FIRE community who 100% believe you need to have a house paid off, and that is to provide a few things. One, a bit of security. Two, an asset that you can then borrow against or draw down on. And three, peace of mind. So the security and peace of mind sort of play into each other, but I'll go through why they are sort of separate as well. Now, there's also the other side of that argument as to not needing to own a property and having the flexibility to move around, not being tied down to one property or the performance of one asset and holding other asset classes like shares, etc., to reach early retirement. So when we look at, for example, that early retirement and our FIRE number, when you are factoring in the cost of living, obviously if we have a house paid off, we're not going to have to pay to live somewhere aside from the maintenance and then the rates and insurances, okay? So if you can essentially wipe out that entire living expense because you have a house paid off, that will mean you need a lot less money invested in order to cover your cost of living. So for example, my current rental cost where I live is $12,000 per year, okay? And this is for just a single one-bedroom apartment. Obviously, my living circumstances may change in the future, but for now, that's what I'm doing. Now, if I were able to have a house completely paid off that I could live in, and I didn't need to have that $12,000 in order to pay rent, that would essentially free up a lot of money that I could, not need to invest, meaning I would reach my financial independence number earlier. Although, bear in mind that the house being paid off is part of your assets, it just means I wouldn't have to have as much in cash producing assets. So if I pop up a calculator here, we're just going to figure out what the actual number is that I would need to not invest once that $12,000 per year is covered. So if, for example, I had the ambition of getting $12,000 per year in income, I would need to actually have $300,000 invested in order to earn that, okay? So that means I would be $300,000 better off not needing that invested in the share market, earning an average rate of 4% in order to reach financial independence number. Now, when it comes to the actual cost of living, obviously because you have all that money tied up in your house, you have an opportunity here. For example, as the price of that asset increases over time, i.e. through the property price index going up over time, you're going to then have an asset you can borrow money against if need be. So let's say your price doubles in value, you could then do a cash out refinance where you can essentially borrow against the value of the property and use those funds elsewhere if you wanted. So you may actually want to divert some of the some of that money into income producing assets such as your shares, listed investment companies, peer-to-peer lending, etc. So it gives you a bit of opportunity to move money around having a house paid off as opposed to retiring still with a mortgage. But to do a cash out refinance, you essentially re-establish a mortgage and you start paying down that loan as you've taken the funds out anyway. So as long as you can cover those repayments, things should be all fine. But at least if you have a house fully paid off, the only expenses that you can predict or expect would be the maintenance, the property rates, insurances, water rates, etc. When you have that loan attached to it, like after a refinance or if you haven't paid it off yet, then you obviously have the interest expense attached to that loan as well. And anytime you lose money, that's a shame because we could actually have that money working for us elsewhere, i.e. in the share market. So the argument that you need to have a property fully paid off is definitely not valid because you don't need it. However, it does provide security. You're never going to have the same problems you have while renting of a landowner or the landlord saying, I need to have you move out of this house, or I don't want to renew the lease because I plan to sell it, etc. So you're kind of able to stay rooted in one place if that is your desire. However, if you're a little more nomadic, it makes sense to rent and not tie yourself down to one asset within a house and be able to move around, okay? Of course, if you did have a house paid off and you decided to move though, you can always rent that house out. You then receive an income while you then go live somewhere else. So the house is definitely an option. If you are planning to be nomadic in your early retirement, obviously renting in many different cities and places can also allow you to find a lower cost of living area. For example, you're not having to live where you're working or where you're pulling a wage from. So then you could go somewhere more remote or regional where the cost of living on average is far less. And this means you could rent out that house you had in a higher income city for possibly enough to cover the rent where you're moving to, and then some if that house was paid off, which is a kind of cool option. However, if you didn't have that house in the first place, obviously then you've got more money to have in the share market also producing some income for you. However, when you have someone on a lease, in theory, if that person is paying the lease or the rent to you, you're at least having a predictable amount of income every single week. We can't accurately predict the income that the share market will return in the short term. We can say the average long-term returns are around about the 8% mark, but that's over a very long time. And if you need a particular amount of income every single year to live on, and then we experience some sort of downturn in the market, for example, what happened in 2020, then you're going to have less income produced from those assets, meaning that your luxury of living, or perhaps the level of comfort you've grown accustomed to during your early retirement, will be affected. What I'd like to suggest is when you figure out what your FIRE number is and how much income you need per month to earn, try and possibly invest more money than that so that you do have a bit of a windfall or a buffer just to kind of help ride out those volatile times. Again, if you had a house with a tenant in it and they weren't paying and they were doing the wrong thing by you or damaging that asset, then when they move out, or whilst they're not paying rent, you're also losing money because you're not receiving income that you otherwise would have elsewhere. So there are definitely many arguments for and many arguments against having a house fully paid off in early retirement. What I plan to do is probably only have one property within my name. Whether it's paid off or not won't matter, because what I'm planning to do is not live in the property that I own, but have it rented out while I spend most of my investment funds in the stock market in order to produce my cash flow from there. The income you receive from shares can be very tax efficient, especially here in Australia with the franking credit system. So I have no reason to want to tie up all my passive income in tax inefficient assets such as those that produce only interest or only rent, because if the house is paid off and the cash is fully if it's fully positively geared, then you have less tax advantages by being the property owner. So you may as well either live in it in that circumstance or go down the route of investing in shares and taking advantage of the tax efficient items or the tax efficient things that we can take advantage of when we are investing in the share market. For example, with the franking credit system, you essentially have a 30% discount on your tax bill, because what has happened is the corporations that pay those dividends essentially have already paid the taxes before they pay that dividend. Now, in early retirement, it's highly likely that your taxable income will be in the rate below the 30% mark. Especially on the first $18,000 you earn here in Australia, that is essentially tax-free income. So this is going to offer you an opportunity to then receive a tax or a franking refund when you do your tax return at the end of the financial year, or it may just lessen some of that tax bill you would have normally received from having that dividend income. So I highly recommend investigating both paths when you're trying to build that plan for your financial independence number, because whilst there are a lot of advantages to having a property, there are also a lot of advantages to not having a property. If you're a person aiming to retire with a lot of investment properties and you have one bad tenant that causes a lot of damages to the house, you could potentially be out of rental income for 6, 12, whatever months while that property is getting fixed, and hopefully your insurance covers it. But if they don't, then you're in a really awkward position where you have to do those repairs yourself out of your own pocket. And during that time, you're also not receiving rental income, and you're going to be stressed out because you're trying to get this house back to a livable state, ready for the tenants to move back in. So there's definitely a lot of whilst there is arguments for security of having an investment property or a property paid off in early retirement, that can also be a lot higher risk because you have a lot of, I guess, pressure on this one asset class to always perform. But it's not just an asset class, it's a single individual property. And who knows what could happen. There could be a flood on the street, or there could be a fire. And in all of these circumstances, you end up in a very awkward and a very painful position, especially if you were expecting income from that asset in order to live your life. So guys, I hope when you are planning your early retirement, you try and look at all of the different methods of income you can receive. And when you're trying to figure out your early retirement number, the amount of money we need invested in shares, for example, will differ if you have a house paid off or if you don't have a house paid off. But essentially, you're going to have around about a similar net worth in that circumstance. So your net worth number is important to know, but the 25 times annual living expenses invested in the stock market earning a 4% return is sort of only relevant to you if you know what your living expenses are before trying to plan for this, and you are accounting for the cost of living somewhere. When you have a house paid off, obviously that reduces significantly how much money you need to have in shares, but then you have that money tied up into that property. And who knows, the property may grow at a faster rate to the share market, and then you can do a cash out refinance, or it may grow at a slower rate to the share market, and you end up missing out on some of the gains you could have earned. It's very hard to predict what will happen in the short term, but over the long term, like I said, we can roundabout expect an 8% return on our shares invested in the stock market. Alright guys, thank you for watching today. If you got any value from this video, please like, share and subscribe, and I look forward to seeing you in the next video.